Is your biggest competitor the market or yourself? At first glance, investing looks like a competition against the market. You try to beat the index, outperform other investors, or time economic cycles better than everyone else. But decades of research suggest something uncomfortable. Your biggest competitor is often not the market. It's you. Let's examine why. 1. The illusion of beating the market. Many investors believe they can consistently outperform broad indexes like the S&P 500. However, long-term performance studies consistently show the majority of active investors underperform the index after fees. Frequent trading reduces net returns. Emotional decision-making destroys compounding. The market is competitive, but human behavior makes it worse. 2. Behavioral finance, the real battlefield. Behavioral finance research shows investors systematically sabotage themselves. Overconfidence bias. Investors believe they are more skilled than they are. Research by Terence O'Dean shows that high-frequency traders tend to earn lower returns. The more confident investors are in their edge, the more they trade. The more they trade, the worse their performance. Loss aversion. Coined by Daniel Kahneman and Amos Tversky, loss aversion explains why losses feel roughly twice as painful as equivalent gains feel good. Investors hold losing positions too long. Investors sell winners too early. This behavior reduces long-term compounding. Recency bias. Investors assume recent trends will continue. After rallies, excessive optimism. After crashes, panic selling. The market cycles. Human emotions amplify those cycles. 3. The market is not emotional. You are. The market has no ego, has no fear, has no need to be right. It simply aggregates millions of decisions. You, on the other hand, want validation. Fear looking wrong. Seek certainty in uncertain environments. This internal conflict often causes more damage than volatility itself. 4. Data on self-inflicted underperformance. Studies of investor behavior repeatedly show the average investor return is lower than the funds they invest in. Poor timing, buying high, selling low, is the main reason. Emotional reactions reduce long-term wealth accumulation. The enemy is rarely the system. It's impulsive behavior. 5. The real competitive advantage. If your biggest rival is yourself, then the solution is not more analysis, more predictions, more trading. It's discipline. Long-term investors who succeed typically use broad diversification, keep costs low, automate contributions, avoid reacting to daily noise. They don't try to outsmart the market. They try to outdiscipline themselves. 6. A hard question. If you removed ego, fear, impulse, the need to constantly act, would your returns improve? For many investors, the answer is yes. Conclusion. Your biggest competitor is not the market's volatility. It's your own psychology. The market tests intelligence. Investing tests character. And in the long run, the investor who masters themselves often outperforms the one trying to master the market.